What if I told you that to make 10, 20, 30 grand a month as a day trader, you don't need to sit at your desk for 12 hours, you don't need a chart full of indicators, and you don't need years of experience. All you need is one 5-minute system. If you can understand this one simple system and why it works so well, you can essentially become a profitable trader overnight. And the only reason why I can tell you this is because that's exactly how I've been consistently pulling over 30 grand every single month for the last 3 years. It's also what helped my students quit their 9-to-5 and make as much as Yobesh doing 10 grand a month and quitting his job using the exact same setup. And in this video, I'm going to break down the only system you need to start pulling consistent profit out of the market. I'll walk you through exactly how it works, why it works, and pretty much just give you the playbook for making 30 grand months on repeat. Now, most traders have no idea why their strategy is losing them money in the first place. They've been told the problem is the strategy. But the real problem is that their strategy is missing the one thing that actually makes price move on the charts in the first place. And that one thing is liquidity. See, the thing is, if you're not trading based on liquidity, you're just gambling on which way the candle goes next. You don't actually know. You're drawing lines, looking at indicators, and staring at moving averages, but none of them tells you the one thing you actually need to know, which is where price is actually trying to go right now. Because price is never random. It's always moving towards something. It always has an objective. It's either moving towards a pocket of liquidity to sweep it or towards an imbalance to fill it. And those are the only two things price ever does on any chart in any market on any time frame, which means that once you start watching the chart with that in mind, the entire thing starts to make sense in a way it never did before. So how does any of this actually translate into a system you can run every morning? Here's exactly how it works. The system I run has 6 pieces, and each one builds directly on the piece before it. So if you miss one, the whole thing breaks down. But when you stack all 6 in the right order, what you've got is a setup that tells you exactly when to get in, where to put your stop, and where to take profit every single morning. So this is the 5-minute system that I run every single day. The first piece is your bias. Before I even think about taking a trade, I need to know which direction I'm trading. And the way I figure that out is by looking at one thing, which is where price is being pulled towards right now. I call this draw on liquidity. The draw on liquidity is just a fancy way of saying the place price is trying to get to. The way I find it is by opening up the 1-hour chart and marking out a few specific things like the session highs and lows, previous day highs and lows, any unfilled fair value gaps on the 1-hour or 4-hour. Once I've got those marked, I ask myself one question. Out of all these levels, which one is price most likely being pulled towards right now? If the answer is above me, I'm bullish for the day. And if the answer is below me, I'm bearish. Simple. And if I genuinely can't tell, I don't trade. That's the entire bias step. And it takes about 1 minute of your time. And the reason this matters is because most traders skip this step entirely. They wake up, they open the chart, and they start looking for setups before they even know which direction you're trading. Which is like getting in the car before you know where you're going. It makes absolutely no sense. That's why bias has to come first. The second piece is structure. Now that I have my bias, I need to make sure the higher time frame agrees with me, because the higher time frame is what actually controls the day. If I'm bullish on the day, but the 1-hour chart has been making lower lows and lower highs for the last 3 days, my bias is fighting the trend, and that's a fight I'm going to lose every single time. Think of structure like the current of a river. You can paddle against it for a while, but eventually the river wins. And that's exactly what happens when you trade against higher time frame structure. So all I do is I simply just glance at the 1-hour and I ask myself one simple question. Is the structure agreeing with my bias right now? Yes or no? If the 1-hour is trending in the same direction as my bias, I get the green light to keep going. And if it's trending the other way, I shut it down and I wait for the next day. And if neither one is happening, meaning the chart is choppy or sideways, I don't take a trade, because you have no edge in a market that doesn't know what it wants to do. The whole step takes about 30 seconds, but it saves me from the most expensive trades I would otherwise be taking. And most often, these are the ones that look clean on the lower time frame but get smoked in the bigger picture. Which leads us into the third piece of this system. the sweep of liquidity. If you've been trading for any amount of time, you've had this happen to you. You see a setup, it looks textbook. You take it, and then price dips into your stop, takes you out, and immediately runs to where you thought it would go in the first place. And you sit there wondering, what the hell just happened? Because your read on the chart was actually right. What you didn't realize though, is that price wasn't moving against you, but it was clearing out the order sitting in the way before it could actually run. And that clearing out of orders is what we call a liquidity sweep. Now, the reason this happens is because the chart is full of stop losses, breakout traders all sitting at the same obvious highs and lows. And before price can actually run in the direction it wants to go, it has to clear out those levels first. So if price wants to run up, it usually dips down first to take out the stop sitting below, and then it runs. Same thing in reverse. If price wants to dump, it spikes up first to take out the stop sitting above, and then it dumps. That is a liquidity sweep. And if you enter before that sweep happens, you're entering at the exact spot that price still has work to do. So price comes down, takes you out, and then runs in the direction you originally wanted. You were right about the direction, but if your stop got hit before the move, you still lost the trade. And the market doesn't pay you for being right. It pays you for being right, but at the right time. The easiest way to picture this is like winding up a punch. You don't throw a hard punch from a still arm. Instead, you pull back first, because that pullback is what loads the power. And the bigger the punch coming, the deeper that pullback has to go. That's exactly what a sweep is on the chart, the wind up before the real move. So in this system, if there's no sweep, I don't take the trade. If price hasn't pulled back to take out a low before I go long or a high before I go short, I'm sitting on my hands until it does. No sweep, no trade. Now, once that sweep finally happens, that's when the fourth piece kicks in. And the fourth piece is displacement. This is where the trade actually starts to take shape, because displacement is what tells me that the windup is finished and the punch is about to land. Displacement is a clean, aggressive move in any direction of my bias after the sweep, and it's the chart's way of telling me that the sweep is done and the real move is starting. The way you spot it is by looking at a candle that breaks structure with momentum that leaves behind what I like to call a fair value gap. And the fair value gap is just a 3-candle pattern where the wick of the first candle and the wick of the third candle don't overlap, which means price moved so fast in that moment that it skipped right past the level it normally would have respected. And then that gap in the middle is what we call the fair value gap. And the reason it matters is because it's essentially a footprint that big money left behind when they aggressively push price in one direction. You can think of it like footprints in fresh snow. When something massive walks through, it leaves a clear trail behind it. And on the charts, that trail is the fair value gap. And price almost always returns to that footprint before continuing to move, which means that footprint becomes my entry zone because I know price is coming back to fill it before it heads to my target. So if I don't see displacement, I don't have an entry, and that's the rule. Because without displacement, there's no fair value gap, which means there's nothing to enter on. The fifth piece is the inversion. That is the final confirmation before I get in. So far, everything in this system has been you reading what the market is doing. The inversion is the first piece where the market actually has to prove something to you first. And the reason this matters is because when price displaces, your brain wants to get in right away. The candle looks strong, the move is going your way, and it feels like you're about to miss out if you don't click buy in the next 2 seconds. But that one candle isn't proof of anything yet. All it shows is that one big move happened. It doesn't tell you whether the move is going to continue or whether it was just a head fake to suck traders in before the real move goes in the other way. And until you know which one it is, you have no business being in a trade. So that's where the inversion comes in. After the displacement, price almost always comes back to retest the fair value gap. And how price reacts to that retest and then inverses a lower time frame fair value gap in the opposite direction is what gives you the answer. If price comes back, taps the gap, pushes back in the direction of the displacement, that's the market confirming that the move is real. If price comes back, slices through the gap, and closes on the other side, that's the market telling you the displacement was a fake out. So the whole point of waiting for the inversion is so that you stop Guessing. You see price actually behave the way it's supposed to before you put a single dollar on the line. That's why I always wait for it. And once that inversion happens, it's time for the sixth and final piece, which is the execution. Now, this is the easy part. Your entry sits right at the close of the inversion candle because that's the exact moment the move got confirmed. Your stop loss goes underneath the swing low that gave you the inversion, because if price comes back through that low, the whole setup is invalidated and you want to get out. And your take profit sits at the next opposing session high or low, because that's where the next big pocket of liquidity price is going to be pulled towards. And guys, that's the whole trade. You set the bracket and then you walk away. And this is the part most traders can't do. Once the trade is live, they sit there watching every candle, hovering over the screen, ready to move the stop the second price pulls back just a few ticks. They tell themselves that you're managing the trade, but what you're actually doing is letting your emotions override the plan that they just built. Hold on, let's think about it for a second, all right? When you built the plan, you were calm, no money on the line, and you looked at the chart objectively. You decided where the trade should fail and where it should win, and those decisions were good ones because nothing was clouding your judgment. But now that the trade has gone live, everything changes. Now there's real money in the trade. Your heart rate is up. Every red candle starts looking like a problem that doesn't exist. So your brain kicks in and starts thinking, maybe I should tighten the stop loss a little. Maybe I should just take a small win now, or maybe this whole thing is about to fall apart. But that's just your brain operating in panic mode. And the best way that I found to deal with panic is to physically not be around when it shows up. That's why when my bracket is set, I close the laptop and I do anything at all, except sit there and watch candles print. Because if you sit there long enough, you will talk yourself out of a winning trade. You will. That's just how it goes. Now, if you want to go deeper into how I actually run this on a live account every morning, watch this next video where I show you exactly what my day trading routine would look like if I had to start over from scratch in 2026.